Good evening, everyone.
Good evening, sir.
How are you doing, Abu? Debbie, good evening. Hussein,
Good evening,
Oluwafemi,
sir.
how are you doing, guys? Please, who is this person with Nokia T20? What's the name, please? What's your actual name? Nokia 220.
Yes, Mr. Shina. How you doing, Shina?
Oh, okay, Shina. You're welcome.
Yes, sir.
Believe, what's the name, please?
I'm Victor, sir.
Victor. Oh, okay. You're welcome. Yes,
Thank you, sir.
without wasting more time, we are going to start almost immediately. I will just brief you. Our objective today is to achieve uh, discussions around cost of debt, cost of convertible security, and also how to calculate weighted average cost of capital. So those are the three things we are going to do today, and I hope we'll be able to complete it. You know, I was telling you last week that cost of capital is very big. Ordinarily, when I'm taking classes on cost of capital, usually span over 1 month because it's all encompassing, and because of the fact that is fundamental to any quantitatives that you may want to do in strategic financial management. And that's why usually I take my time to explain the principle for students to understand. So before we go to other areas of the syllabus. However, so I will just brief you a little bit on what we did in our last class. Okay, let me share my screen so that we'll be speaking on the same page. Okay. So, you're welcome once again. Yes, last week we started cost of capital, and we discussed the introduction to cost of capital, the importance of cost of capital. I demonstrated for you how to calculate cost of equity, cost of preference share. And I think that's where we stopped. We stopped at cost of preference share. We said that cost of capital is the compensation required by the suppliers of capital from their investment in a company. When you say, I think, hold on. Okay, so last week we started with cost of capital, and we said that cost of capital is the compensation required by the providers of capital from their investment in a company. And when you talk about providers of capital, what it simply means, the suppliers of funds, those investors that have contributed their capital to finance the operation of the company. And I mentioned that there are three major providers of capital to a company, a long-term financing. One is the ordinary share capital. Second one is the preference share holders, as well as the debt holders. These categories of investors, they've contributed their funds to set the company going and also to finance the operations of the business. So they are expecting a rate of return on their investment. So we said that we are looking, when you talk about cost of capital, we are looking at the perspective of the company, not the providers of capital, because it is the company that will be providing, that will be paying the rate of return, the return on investment on the capital that those investors have supplied to the company. Therefore, to the company that is paying, because it's a cash outflow, all right? It's a cash outflow to the company. Therefore, it is cost of capital to the company, but those providers of capital that will be receiving the return on their investment, to them, it is a return on investment, but to the company, it's a cost of capital. So we now said that the rate of return or the return on investment on the capital provided by the ordinary shareholders is in form of dividend, whereas the rate of return that will be received by the preference shareholders is in form of a fixed dividend, while the rate of return that will be received by the debt holders is in form of interest expense. And we said that cost of capital is determined by the forces of demand and supply. Okay, it is the market participant that would determine how much the cost of capital should be. Not only that, the cost of capital it depends on the degree of the perceived risk of the company, in that if the risk associated with the company's business is high, the cost of capital will also be high, and vice versa. So after that, we'll talk about the importance of cost of capital. I told you in the class that there are two major importance of cost of capital. One is for project appraiser, that is investment appraiser. Then two is to determine the debt equity proportion. When you talk about investment appraisal, when you want to determine the financial viability of a project, you are going to need cost of capital to discount the future cash flow to its present value equivalent. Without the cost of capital, it will be difficult to achieve that. So that's one of the importance of cost of capital. For example, when you want to determine the financial viability of a project using net present value or internal rate of return, or maybe adjusted present value, you are going to need discount rates, which is your cost of capital, to discount the future cash flows. So without the cost of capital, that would be very difficult. Then the second one is to determine the debt equity proportion. The reason being that in a company's capital structure, there are ways a company will finance its operation. For example, a company can finance its long-term, can access a long-term funds through equity, through debt, or preference share. So each source of finance has its own underlying cost. Therefore, the cost of capital will tell you how much of equity you should carry in your book, how much of debt you should carry in your book, in order to minimize the overall cost of capital to the company. Because it is important. One of the objectives that an organization wants to achieve is to minimize the overall cost of capital, all right, in order to enhance the owner's value, okay? And then after that, we'll now move to calculating cost of equity. We said that before you can calculate your cost of capital, which is your weighted average cost of capital to a company, you must first of all understand the elements of the weighted average cost of capital. There are three key elements of the weighted average cost of capital, depending on the way the company finances operation. When you have equity, of course, for a company must surely have ordinary share capital, because that's why it is a company. It must have ordinary share capital. As a result, we need to calculate cost of equity, because cost of equity is the minimum rate of return expected by the ordinary shareholders from their investment in the company. All right. So, and I said that, okay, how do you estimate cost of equity? I gave you three methods of calculating cost of equity. Number one is to use dividend valuation model. You can use dividend valuation model to compute cost of equity. Number two is to use capital asset pricing model to calculate cost of equity. And the third one is Miller and Mondigliani. And I mentioned that the second and the third one, which is a capital asset pricing model, the capital asset pricing model is a topic on its own that when we get there, I will explain to you in details. Also, the Miller and Mondigliani, when we get to adjusted present value, we are going to make use of it, and then I will expose the formula to you when we get there. Then I now said that our focus for this period will be how to estimate cost of equity using dividend valuation model. And I told you that we are going to use dividend valuation model if and only if you are given dividend information in the question. When you go to the balance sheet of the company, or when you go to the profit and loss accounts, you can see the dividend information. Then that means that you are expected to use dividend valuation model. And I've said that cost of equity is cost of equity using dividend valuation model is the ratio of dividend to ex-div share price. Okay, cost of equity using dividend valuation model is the ratio of dividend to ex-div share price. And I've said that to estimate your cost of equity using dividend valuation model will depend on the nature of the dividend, because dividend can be constant to perpetuity, dividend can grow. So I demonstrated the formula you can use when dividend is constant and also where there's growth in dividend. We also proceed. I mentioned to you under the cost of equity that it is better for you to always use ex-div share price as your denominator so that you don't forget in the question, because examiner may hit mostly the dividend that will be given to the share price that will be given to you would be cum div share price, and you don't use cum div share price to estimate cost of equity. Rather, you need ex-div share price, because cum div share price is the share price that included dividends, whereas ex-div share price is the share price that excluded dividend. So it is the share price that excluded dividend you are going to use to compute your cost of equity. So what that means is that if cum div share price is given, you need to convert it to ex-div share price before proceeding to calculating your cost of equity. That's one principle you must understand. Then we proceeded to talk about how to estimate growth rates. There are two formulas, two methods I gave to you for calculating growth rates. I said that when the history of dividend payment is given in the question, when history of dividend payments is given in the question, then you are supposed to use the historical patterns of dividend payment to compute your cost of equity. However, when the information on earnings or capital employed are given in the question, then you are expected to use Gordon growth to estimate your cost of equity. All of this we discussed in our last class. Then after that, we move to cost of preference share. We said that cost of preference share is the amount paid to is the rate of return or compensation paid to the providers of preference share capital, okay, from their investment in the company. And we said that preference shareholders are settled before the ordinary shareholders in the event of liquidation, but after the debt holders might have been settled. We also said that there are cumulative preference share, non-cumulative preference share, redeemable preference share, irredeemable preference share, participating or non-participating preference share. All this we discussed in our last class, okay? Then, of course, I now mentioned that under preference share, the only area that we have to do, that has to do with calculation is the redeemable and irredeemable. So we define redeemable preference share as the one in which the company will pay the annual fixed dividend and the principal at the maturity date. All right. And we said that when you want to calculate cost of redeemable preference share, you are supposed to calculate internal rate of return. You are supposed to calculate internal rate of return by assuming two discount rates that will produce two opposing NPV. Then thereafter, you proceed to calculating the internal rate of return using the internal rate of return you are familiar with. So this is the internal rate of return you are supposed to calculate when you want to. You are supposed to use when you want to calculate cost of a redeemable preference share. And we said that the irredeemable preference share is the one in which the company will pay only the annual fixed dividend, but the principal will not be repaid at all. The company will not repay the principal. So only the fixed dividend will be paid to perpetuity. All right. Then we now said when you want to calculate the cost of irredeemable preference share, it's just the ratio of fixed dividend to ex-div share price. There's nothing like growth when you want to calculate cost of irredeemable preference share. There is no growth rate in that one. So it's just the ratio of fixed dividend to ex-div share price. And then, of course, the preference shareholders are only entitled to fixed dividend. Okay, they're entitled to fixed dividend. That's why there is no growth in preference dividend. Okay, so that's where we stopped in our last class. So today, by the grace of God, we are going to talk about cost of debt. Okay, so let's take it slowly for today's class, which is the cost of debt. What do you mean by cost of debt? The cost of debt is just the actual amount paid on the debt or on the loan borrowed. So the actual amount paid on the loan borrowed, or you can say cost of debt is the compensation required by the providers of debt capital from their investment in a company. In the event of liquidation, the debt holders will be settled before the preference shareholders and also the ordinary shareholders. Okay, so there are callable and non-callable debts, redeemable or irredeemable debts. They are some of the callable and redeemable are somehow similar, but they are different. Okay, but they are different. However, I don't want to go into details on what callable or non-callable is all about. The kind of calculation you are going to see on the day of your exam would be under redeemable or irredeemable debts, because callable or non-callable, they are just theoretical. They are purely theoretical. So when we get there, I can just brief you. But for now, let's focus on the redeemable and the irredeemable debts. All right. Now, when you talk about redeemable debts, just like you have redeemable preference share, the redeemable debts is the one in which the company will pay annual fixed interest and the principal at the redemption date or at the maturity date. So there are two different cash flows that the company will settle the providers of debt capital. One is annual fixed interest, and two is the repayment of the principal sum at the maturity date. So those are the two elements under cost of redeemable debt. However, how do you then calculate the cost of redeemable debt? The cost of redeemable debt is calculated similar to cost of redeemable preference share. That is, you need to calculate the internal rate of return. When you want to calculate cost of redeemable debt, simply go ahead and calculate internal rate of return. So how do you calculate your internal rate of return? Like we explained last time, there are two procedures you are going to carry out. One is to assume two discount rates that will produce two opposing NPV. What do I mean by that? One discount rate will give you a positive NPV, then the second discount rate will produce a negative NPV. Then you now use the internal rate of return formula to calculate your cost of redeemable debt. It's as simple as that. It's as simple as that. But the only difference between cost of redeemable debt and cost of redeemable preference share is the fact that the cash flow you are going to use under cost of redeemable debt is different from the cash flow you are going to use under cost of redeemable preference share. So for the cost of redeemable debt, of course, we are going to need the annual fixed interest, annual fixed interest. That's number one. So we are going to calculate the present value of the annual fixed interest. Then you go ahead again and calculate present value of the redemption value. Okay, calculate the PV of the redemption value. So you add up the present value of the fixed interest and the present value of the redemption value. Add the two together, let's say from the cash outflow, then you have your NPV. You do for the first discount rate, you do for the second discount rate, then thereafter we proceed to go and calculate your cost of redeemable debt using the internal rate of return formula, okay? So to do that, the A part of this formula is lower discount rates. You know, I told you are going to assume two discount rates that will produce two opposing NPV. So the lower of the two discount rate that you assume is A. The higher of the two discount rate that you assume is the B. So just interpolate everything in the formula for IRR, then you get the cost of redeemable debt. All right. So it's very straightforward. It's very straightforward. And by the time we start calculation, you will see what I'm talking about. All right. So that is how to calculate cost of redeemable debt. I will repeat again. when you want to calculate cost of redeemable debt, what examiner is expecting you to do is to calculate internal rate of return. How do you calculate your internal rate of return? One, you need to assume two discount rates that will produce two opposing NPV. That is, one discount rate will give a positive NPV, then the other discount rate will produce a negative NPV. Then you now proceed to calculating your internal rate of return using the formula of internal IRR. Okay, so that is that. Then let's talk about cost of irredeemable debt. The cost of irredeemable debt is the one in which the company will pay the annual fixed interest, but the principal will never be repaid. Okay, the company will pay the annual fixed interest to perpetuity, but the principal will not be repaid. Okay, so that's cost of irredeemable debt. In calculating the cost of irredeemable debt, it's just the ratio of the fixed interest to X int price. Okay, when you want to calculate the cost of irredeemable debt, is the ratio of fixed interest to X int price. Okay, this is it here. KD, the ratio of fixed interest to to X int price. So again, you can see here I put X int price. I like to use X int price also because I don't want to forget, because on the day of your exam, examiner will give the price that examiner will give to you may be cum int price, and you don't use cum interest price. You have to use X interest price. And that's why I love to use X interest price instead of using ordinary letter, so that you don't forget. By the time you put X interest price, something will call your mind that I need to go back to the question to go and check the value or the price of this debt, whether interest expense has been paid or not. Because before you calculate your cost of redeemable debt or cost of irredeemable debt, the interest expense must have been paid. If not, you need to go and convert it. You need to go and convert the price that included the interest. You need to convert it to the price that excluded the interest. So that's that. Now, there's one more thing you need to know under debt. When you want to calculate cost of debt, usually debt is issued at 100 naira per unit. Debt is always issued at 100 naira per unit. Okay. Now, debt can be issued at par, at a premium, or at a discount, because I mentioned that debt is issued at 100 naira per unit. The par value of a debt, is 100 naira. Therefore, if debt is issued at a premium, it means that it will be more than 100 naira. Okay, if debt is issued at a premium, it means that the value will be more than 100 naira. So if debt is issued at a discount, it will be lower than 100 naira. But however, the par value of a debt is 100 naira. That's what I said, that debt is always issued as 100 naira per unit of the debt. Okay, so that's for that. Then there's one more information you need to know. Examiner can maybe, what do you understand? What are the types of debts? There are basically two types of debts. We have traded debts. We also have non-traded debts. But before we go to the types of debts, I mentioned to you the other time that when you want to calculate your cost of irredeemable debts, it's just the ratio of the fixed interest to X int price. Now, the two things can happen. If in the question you are given tax rates, you are given income tax rates, then you need to adjust for tax. Because cost of debt, where there is tax, cost of irredeemable debt where there is tax is calculated as the fixed interest. The fixed interest multiplied by 1 minus tax rates divided by the X int price. X interest price multiplied by 100 over 1. So this is the formula for calculating cost of irredeemable debt where there is tax. Whenever you are given tax rate, this is the formula you are going to use. But where you are not given tax rates, then it's just the ratio of fixed interest to X price. So you use this one where there is tax, where you are given tax rates. You use this formula where there is no tax. Where there is no tax. Okay? So that's the difference between the two. So we can then go to types of debts. Yes, I said there are two types of debts. There is traded debts. There's also non-traded debts. Types of debts. Okay. One is traded debts. Two is non-traded debts. So what do you mean by traded debts? Traded debts are fixed income securities that can be bought or sold in an organized financial market. I will repeat. Traded debts are fixed income securities that can be bought or sold in an organized financial market. Examples include bond, debenture, or loan notes. Those kind of securities are tradable. You can buy them. You can also sell them in the market, in the financial market. All right, that's why it is traded. Okay, it is called fixed income. It is called fixed income security because of the fact that the interest expense that the debt holders will receive is fixed in nature. The interest expense is not, it's not growing, doesn't have, it will not appreciate. So it's constant, it is fixed. The coupon payment, the coupon rate that the debt, the company will pay to the debt holders is fixed, is constant in nature. And that's why it is called fixed income securities. Now, the second part, the second type of debt is the non-traded debt. The non-traded debts are the kind of security that is not tradable or that cannot be bought or sold in an organized financial market. Examples include bank loan or overdrafts. You can't take your overdraft or the loan you borrow from your bank, take it to the market and say you want to sell it. It's not possible. All right. So those are non-traded debts. I said the examples of non-traded debts include the bank loan as well as the overdraft facility. All right. So examiner cannot be asking you to be defining traded or not traded, but it's good for you to have it as information. Or you never can tell. All right. So that's that. Now, so when you do, of course, you already have the material, you can just go through them and have the understanding, have more understanding. So at this point, we need to go to cost of convertible securities. Let's talk about cost of convertible securities. So once we are done with cost of convertible securities, then I will explain weighted average cost of capital. Then we'll now spend the remaining hours to do calculations, okay, to do calculations. So what do you mean by convertible securities? The convertible securities are fixed income securities that have the attributes of convertibility. I will repeat. Convertible securities are fixed income securities that have the attributes of convertibilities. That is, they are fixed income securities that can be converted to a known number of ordinary shares in the future. All right. For example, the example of convertible securities include the preference shares, bond, loan notes, or debentures. You can see those are fixed income. The preference shareholders is entitled to fixed dividends. The debt holders are entitled to fixed interest. So they are fixed income security. So the preference shareholder can decide that, okay, instead of the investor to redeem the preference share at the maturity date, or instead of the bondholder to redeem the bond at the maturity date, it may decide to convert it to a no number of ordinary shares in the future. All right. So, however, the investor will only do that. The investor will only exercise the right if and only if it is profitable to do so. What that simply means is that if the conversion value at a later future date or at a specified future date is higher than the redemption value, then the investor may exercise the right. So the cost of convertible security is the same thing, is calculated the same way as cost of convertible debt or cost of convertible preference share. Is the same way. The only difference is just the fact that where you are supposed to use redemption value, you are going to use conversion value. All right. So at the end of the day, when you want to compute your cost of convertible securities, you are supposed to calculate your internal rate of return. I will repeat, when you want to calculate the cost of convertible security, you are supposed to calculate internal rate of return. So what's the difference? Because when you want to calculate cost of redeemable debt, you say you calculate internal rate of return. When you want to calculate cost of redeemable preference share, you say it is internal rate of return. Yes, it is true. However, when it comes to cost of convertible securities, it is also, you are also going to calculate the internal rate of return. The only difference is just the fact that you are going to select the higher of the conversion value or the redemption value. Say, for example, you have a debenture and you have a convertible debenture. So, of course, when you want to calculate your internal rate of return, remember, you are supposed to assume two discount rates that will produce two opposing NPV. All right, the same thing you are going to do under cost of convertible security. But where you are supposed to put your redemption value, you are going to put conversion value. That's just the difference. This is what I'm saying. In the determination of cost of convertible security, you are expected to select the higher of 1, redemption value, 2, conversion value. So if the conversion value is higher than the redemption value, then the investor will exercise his or her rights. But if the redemption value is higher than the conversion value, the investor will just allow the security to lapse and redeem. Just allow the security to lapse and redeem at the maturity date because it is not profitable to the investor. All right. So that's how to calculate your cost of redeemable, cost of convertible securities. I will repeat. When you want to calculate your cost of cost of convertible security, you are going to calculate internal rate of return. However, instead of you to use redemption value, you may use conversion value, depending on which one is higher. If redemption value is higher than the conversion value, then of course, investor will not exercise his right because it is not profitable. But if conversion value is higher than the redemption value, investor will exercise the right that investor will convert to a new number of ordinary shares in the future. So irrespective, you are going to calculate internal rate of return. So that's just what cost of convertible security is all about. So you can just go through them. I've summarized it for you. You can go through the notes and gain more knowledge on that. So at this point, let's have illustrations on cost of convertible security. I'll take it from there because most of all the calculations we are going to do under weighted average cost of capital will be based on cost of equity, cost of preference share, and the cost of debt. So let's have illustration to explain how to calculate or how to estimate cost of convertible security. Go to your material, open the material, illustration number, let me see. Illustration number, what is that? Okay, so go to your material, illustration number 13. Let's solve this question on illustration number 13. Okay. I want to believe you have the material in front of you, please. Let's read together. Singapore Limited has 10% convertible debentures with a current market value of 106 Naira. And interest payment was made recently. So what that means is that since interest expense has been paid, it means that this price, the current market price of this convertible debenture of 106 is X int price. That's X int price because the interest payment was made recently. Okay. The debenture will be converted to equity shares in 4 years' time at the rate of 4 shares per 10 Naira of debenture. The shares are expected to have a market value of 3 Naira 50 kobo each as at that time. What's the cost of capital to the company for the convertible debentures? When company tax rate is 40%, and assume that tax payment occurs in the same year that the interest payment arises. So this is a question. Examiner wants you to calculate cost of convertible debenture. That's the requirement. So you want to calculate cost of convertible convertible debentures. So how do you do this? Like I mentioned to you the other time, the cost of convertible debenture is the same thing as internal rate of return. You are going to calculate internal rate of return. However, the only difference between cost of convertible debenture and cost of redeemable debenture is the fact that you need to compare your redemption value with the conversion value. So if your conversion value, whichever one that is higher, is what you are going to use to compute your NPV. So sorry, to compute your internal rate of return. If redemption value is higher, that means the investor will not convert. Okay, the investor will not convert to a no number of ordinary shares. But if your conversion value is higher than the redemption value, then the investor will exercise his or her rights. So at this point, let's solve this question briefly within the next 10 minutes. Let me look for a space within this document. Okay, let's use it. All right. So the name of this company is Singapore. All right. So I would then say Singapore Limited. So I want to calculate cost of convertible debenture. The first thing first that I need to do is for me to go and confirm what is the conversion value, what is the redemption value. In this question, the examiner did not tell us the redemption value. Of course, whenever you are not told how a debt will be redeemed, of course, we are going to assume it will be redeemed at par. You are going to assume it will be redeemed at par. One more thing I did not tell you earlier today when I was explaining is the fact that for preference shares to be redeemable or for debts to be redeemable, the redemption date must be given to you. If you're not given the redemption date, then there is no way you can calculate cost of redeemable preference share or cost of redeemable debt. So what that means is that you are simply going to calculate cost of irredeemable preference share or cost of irredeemable debt. I will repeat, where the redemption date is not given to you for preference share or for debts, for debt capital, therefore you are going to assume that we are going to calculate for cost of irredeemable preference share or cost of irredeemable debt because you need that redemption date. You need the redemption date. So remember, when you want to calculate internal rate of return, you are supposed to assume two discount rates that will produce two opposing NPV. One discount rate will give you a positive NPV. Another discount rate will give you a negative NPV. Therefore, I will then go ahead. I will design my table that I want to use to compute my NPV. So I will say assume. Now, whenever you want to assume your discount rate to compute your internal rate of return, always start with 10%. Always start from 10%, because if 10% is positive, you can easily increase to 15%. But if 10% is negative, you can easily reduce it to, if 10% is negative, you can easily reduce it to 5%. But if you start from 5%, 5% is positive, you increase to 10%, 10% is positive, you continue to do iteration. And that's why when you start from 10%, you are in between, all right? So watch out for that. Now, we want to start from 10% discount rates. You can see this 10% is not given in the question. You are the one that will assume the discount rates. Whenever you want to compute internal rate of return, you are the one that will assume the discount rate to be used, okay? So it will not be given to you in the question. Therefore, I want to use this to compute my internal rate of return. However, I'm teaching you right now exam method. So instead of me to calculate two different NPV in different tables, I'm going to use only one table to compute my NPVs. Okay, the positive NPV and the negative NPV will be computed within the same table. That will save my time because it's the same cash flow that you are going to use for each of the discounting rates. So I'll come here. I don't know the extent my table will last. So the first item will be the year. I will create a column for the year. The next item will be the description of items. Okay. Then I'm going to have a column for cash flow, a column for discount factor. At, I don't know, the discount rate, we have assumed 10%. Then we are going to have a column for present value. Okay. All right. Now, I will go back to the question. Am I given, what's the maturity dates? According to the question, illustration number, what is that? I think that's illustration number 13. Yes. Thank you. Illustration number 13. So what's the maturity date? Examiner has told us that the debenture will be converted to equity shares in 4 years' time. In 4 years' time. So what that means is that for the first year, second year, third year, and the fourth year, the debenture holders will receive fixed interest from the company. The debenture holders will receive fixed interest from the company. Therefore, instead of me to be doing year 1, year 2, year 3, year 4, I will just use annuity factor because it's constant. It's the same amount of interest expense that the debenture holders will receive. So it's better for me to use annuity factor and get my answer quickly, move on from there. So what I miss is that I need to go down there where I have my solution table. So here will be year 0. Then since the maturity date of this debenture is, the redemption date is 4, it's 4 years time. Therefore, I will do year 1 to 4. This will be my fixed. Of course, the year 0 is the current market value. That's the current market value of the debenture. Then for the year 1 to 4, the company will pay annual fixed interest to the debenture holders. Therefore, here will be fixed interest. Then at year 4, this debenture could either be redeemed at par or converted to a no number of ordinary shares. So I will compare the two. Whichever one that is higher is what I will come and put here. Right now, I won't put any letter or any word into that place. I will just leave it blank. Okay. So my NPV will come here. I will divide this one into 2 because I need to assume 2 discount rates. The first discount rate is 10%. I don't know what the second discount rate would be. We'll come back to that place later on. Then the present value of the 10%. Then the present value of the second discount rate will go to that place. Then I need to go back to the question. Let's go and be picking the numbers one by one. At year 0, that's where you are going to have the current market value of the debenture. According to the question, the current market value is 106 naira. And we are told that the debenture interest has just been paid. The company has paid the debenture interest. This is the current market value we are looking for, 106 naira. That current market value will be accounted for in year 0. And we are told that the interest expense was made recently. If the interest expense has not been made, we need to deduct the interest from the 106. This interest of 10%, we are going to less it from the 106 if interest has not been paid, because you don't use cum int price, rather you use X int price. But because the 106 naira is already X int price, that's why we are not adjusting for interest. Okay, that's why we are using the 106 the way it is given in the question. So that's one. Then, of course, the interest expense is 10%. Now, let me do it one by one so that you don't get confused. So, the current market value is 106. Therefore, I will then come here. Cash flow is 106. At year 0, you put it in brackets. 106 in brackets. Discount factor at year 0 is equal to 1. 1 multiplied by 106 will give me 106. I'm done with the current market value. Let's go to fixed interest. The coupon rate of this debenture is 10%. If in the question I don't have tax rates, what I will just use is to pick the 10% and come and put it in that place. But because of the fact that in the question, examiner has given to us tax rates, therefore I cannot use this 10%. I cannot put the 10 there. I need to go and determine my post-tax interest or after-tax interest, because debt is a cheaper source of financing because of tax deductibility benefits. As a result of debt or as a result of tax, the company will pay a lower coupon to the debt holders, because the company will have the tax benefits as a result of investing with debt capital. Therefore, what is the company tax rate given in the question? We need to go and make our adjustments. What's the company tax rate given? According to the question, the company tax rate is 40%. So let's go and adjust for tax. We want to calculate post-tax interest. We want to calculate post-tax interest. Let's do our working here. Working. Number 1, post-tax interest. Post-tax interest is the same thing as after-tax interest, which is calculated as interest multiplied by 1 minus tax rates equal. The coupon rate given in the question is 10%. That is, the interest rate is 10%. So forget about the percentage on the interest rates. Forget about the percentage, because debt is quoted at 100 naira per unit. So just ignore the percentage behind the 10. So here will be 10 multiplied by 1 minus tax rate. My tax rate is 40%, 0.40. Therefore, this will be 10 into 0.6. Therefore, my after-tax interest is 6. So I would then come, if my after-tax interest is 6, that would then come in and put 6. But if in the question you are not given tax rates, so that means you are going to use the coupon rate like that. You are going to use 10% like that. So no need for adjustment. But because we are given tax rate, that's why we have to come and calculate the after-tax interest or post-tax interest to arrive at that 6. Okay? Then, finally, we need to consider what we are going to, the letter or the words we are going to put there. Are we going to redeem the debenture, or we are going to convert it to a known number of ordinary shares? So let's go and do our working for us to be able to achieve that. Working number 2 now. Working number 2, we want to determine the conversion value. Conversion value. We go back to the question. How are we going to convert the debenture to number of ordinary shares in the future? Examiner has told us that to convert the debenture to ordinary share capital, we are told in the question that the debenture will be converted to equity shares in 4 years' time at the rate of 4 shares per 10 naira of debenture. Okay? The shares are expected to have a market value of 3 naira 50 kobo each as that time. So what that means is that we need to multiply 4 multiplied by 10 multiplied by 3.5. It gives us the current value. So I will then go back to my workings to say equal to conversion value is equal to 4 shares at 10 naira multiplied by the current market price. The current market price, we are told, is 3 naira 50 kobo. So when you use your calculator to do this, let me bring out my calculator. So this is 4 multiplied by 10 multiplied by 3.5. That's 140. Okay? That's 140. 140 naira is the conversion value. Now I need to compare this conversion value with the redemption value. Remember what I told you when I was explaining cost of convertible security. I said that investor will only convert if and only if it is profitable to do so. How will you know whether it is profitable? Once the conversion value is higher than the redemption value, then the investor will exercise his or her rights. So as a result, I need to compare the higher of, I'm going to select the higher of one, redemption value. Then 2, conversion value. So according to the question, examiner did not tell us how the debenture may be redeemed, but it is implied in the question. Once you are not given the redemption value, then you are going to assume that it will be redeemed at 100 naira per unit. Okay? It will be redeemed at 100 naira per unit. Then the conversion value we have computed is 140 naira. Therefore, we are going to select the higher of the 2. As you can see, the conversion value is higher than the redemption value. Therefore, the investor will exercise his or her rights. The debenture holders will exercise their rights. So instead of me to put redemption value, I will put conversion value. So I will then come here, conversion value. Conversion value, V is the value. How much is it? 140 naira per unit of the, per unit. Now, the next thing I need to do is to get the present value of the fixed interest, the present value of the conversion value. How do I do that? Very simple. All I need to do is to discount the future cash flows. That's it. So to do that, because my fixed interest of 6 naira per annum is constant from year 1 to 4, is constant at 6 naira. So I need to go and calculate annuity factor. So I will then come here, working number 3. Annuity factor. AF. The annuity factor is calculated as 1 minus 1 plus cost of capital raised to power minus n, all divided by R, which is equal to, because we're assuming 10%, for the first instance, we're assuming 10%. Therefore, I would then say 1 minus 1.10, because the R is equal to 10%, raised to power how many years? 4 years, raised to power minus 4, divided by R, which is 10%. The 10% we are using is the 10% we assume here. No, we assume 10%. So at this point, I'll bring out my calculator. What do I have there? I would then say raised to power, excuse me, let me clean what I have in the calculator before. So 1.1 raised to power 4 minus equal minus 1 equal divided by 0.1 equal. That's 3.17. Here is 3.170. Please, on your own, at your own hand, use your calculator and confirm that you get the same answer. So you have to follow me the same way I'm doing it so that you don't get lost. All right, you must know how to calculate annuity factor. One thing I need to remind you is the fact that if this is your first time at professional level, if you are just writing strategic financial management for the first time, please, you must be ready. You must be ready to memorize formulas, because majority of what you are going to do in SFM are quantitative, and at the same time they are formula driven. Because on the day of your exam, the formulas the examiner will give to you at the back of your question paper may not be more than 7. In fact, it will not be more than 7. And in some instances, most of the 7 formulas may not be relevant to your calculations. So what that means is that you have to be ready to memorize formula. Your starting point is to ensure that you understand and memorize all the relevant formulas on each of the topics as you are being taught. Please, very, very important. So now that I have 3.170, then I need to go and discount. I will come here, 3.170. So I need to multiply with 6. I would then say 6 multiplied by 3.170 equal, that's 19.02. I will come under 10, 19.02. I can restrict my number in thousands, sorry, for old number. So let's say 19.02 is 19. All right, round it. The next item for me is to calculate discount factor at year 4. Discount factor of year 4 at 10% will give me 0.683. 0.683. At this point, at this level of professional, you are supposed to understand all of this. I shouldn't be telling you what is discount factor, what is annuity factor. But for the because of the constraint, because of the fact that you are not seeing me physically, and that's why I have to do this at this first instance. Going forward, it is expected that you know how to calculate annuity factor or discount factor. But for now, I want to assume that you don't know how to calculate annuity factor. So working number 4 for me would be, let me use this space. Working number 4, let me use this space, is discount factor at 10%. Discount factor is calculated as 1 plus R raised to power minus N equal 1 plus R raised to power minus N, which is equal to 1.1, because we are assuming 10%, 1.1 raised to power minus, we are looking at year 4. We want to calculate discount factor for year 4, raised to power minus 4. So the final answer should be 0.683. Okay, 0.683. All right, then. So use your own calculator to confirm that. So here, so I will then multiply 140 multiplied by 0.683. Okay. Excuse me. 140 multiplied by 0.683. That's 95.62. So rounding, that's 96. This is 96. 96 plus 19. 96 plus 19 equal to 115 naira minus 106 minus 106 equal 9. Here I will put 9. So we assume 10%, and that 10% produce a positive NPV of 9. Therefore, let us assume 15% in order to have a negative NPV. Therefore, we're assuming 10 and then 15%. So here will be 15%, then 15%. Here will be 1. 1 multiplied by 106 will give us 106. So let's go and calculate annuity factor of year 1 to 4 at 15%. The same way we calculate this annuity factor is the same way we are going to calculate the one for 15%. Therefore, I'll bring out my calculator because you already have examples, so there's no need for me to be doing working for that again. I will just say 1.15, since we are assuming 15%, 1.15 raised to power 4 minus equal minus 1 equal divided by 0.15 equal. That's 2.855. 2.855. So my annuity factor for year 1 to 4 at 15% is 2.855. Then what's the discount factor for year 4 at 15%? So I will say 1.15 raised to power 4 minus equal 0.572. Here is 0.572. So let's multiply. I would then say 140. Before that, 6 multiply by 2.855 equal 17.13, rounding 17. Next, 140 multiplied by 0.572 equal 80.08, rounding 80. Therefore, 80 plus 17 equal 97 minus 106 equal minus 9. The NPV is minus 9. So we assume 10%. 10% produce a positive NPV. We then increase to 15%, and 15% produce a negative NPV of 9. Therefore, at this point, we have positive NPV and negative NPV. We can then proceed to calculate the cost of convertible debenture, which is internal rate of return. I would then say KD, that is internal rate of return, equal to the lower discount rate plus net present value of the lower discount rate divided by net present value of the lower discount rate plus net present value of the higher discount rate. All of this multiplied by higher discount rate minus lower discount rates. Therefore, my cost of convertible debenture is equal to, I assume 10 and 15%. A is the lower discount rate of 10 plus NPV of that 10% is 9 divided by 9 plus NPV of higher discount rates, which is also 9, multiplied by higher discount rate of 15 minus lower discount rate of 10. Final answer. The cost of convertible debenture is equal to 9. Excuse me, let me write that. Is equal to 9 divided by 18. 9 divided by 18 equal, sorry, it's a mistake there. 9 divided by 18 equal 0.5 multiplied by 5. The difference between 15 and 10 is 5 equal 2.5 plus 10 equal 12.5. So 12.5% is the cost of convertible debenture. 2.5% is the cost of convertible debenture. So that is what examiner wants you to calculate. That's what examiner wants you to calculate. So I believe you understand this. Please, before we move to the next one, let me know, let me hear from you if you understand what we have done so far under cost of convertible security in this calculation. You can ask me a question if there's any, if you have any concern or question. Okay, if there are none, so let's proceed.
So I
So
have a
that's that.
question.
So who is speaking, please?
It's Prosper.
Prosper. Okay, talk to me.
Yes, sir. So, with your formula, you wrote MPVA plus MPVB, right? And then
Yep.
you did 9 plus 9. I thought the MPVB is minus 9. Why do you have plus?
Yes, in the original formula, you're right. In the original formula, this one is minus. Okay, that's the
Yes,
original
sir.
formula. That one is minus. But you know, minus times minus will give you positive, isn't it?
Okay, yes, it is.
So that's why you usually see this one as positive instead of minus. All right?
Okay, all right. Thank you, sir.
You are welcome. So if there are no other questions, let's move to, now, examiner can ask you to calculate or to determine the value of a convertible security. The value of a convertible security is calculated the same way as value of redeemable debts. And the value of redeemable debts is the present value of future cash flows discounted at the yield of the debt. Now, what do I mean by the present value of future cash flows? When you want to determine the value or the market value of a debt, be it debenture, loan note, or bond, or even preference share, all right? So it's the present value of future cash flows. The future cash flows of debts are in two folds. I mentioned it earlier today. The future cash flows of debts are in two folds. One is the fixed interest, annual fixed interest. Then the second one is the redemption value. Redemption value or conversion value, depending on whether it is convertible debt or redeemable debt. Okay, so these are the two cash flows. These are the two future cash flows. So when you want to determine the market value of a debt, it's simply the present value of future cash flow. Just go ahead and calculate the present value. How do you calculate? We've already done the present value earlier today. What we have here at this place, at this line, and this line, add the two of them together. These two, add them together. That will give you the present value. That the same cash flow. This interest is the cash flow. The conversion value or redemption value is another cash flow. So the present value of those two elements discounted at the yield. The yield is the internal rate of it. It could be called internal rate of return. It could be called cost of debt. It could be called yield to maturity, depending on the way the question is being structured. So when you are asked, I will repeat, whenever you are asked to determine the market value of a debt, it's simply the present value of the future cash flow discounted at the yield of the debt. Okay? Again, if you are asked to calculate the market value of preference share, is the present value of, of future cash flows. What is the future cash flow for preference share? The fixed dividend and the redemption value, discounted at the rate of return of the preference share or cost of preference share. So all these things, you have to know them, all right? Because when you get to bond valuation, you are going to need that information, okay? So let's have one more illustration under cost of convertible debt before we go to weighted average cost of capital, okay? So you remember, in this question we just solved, yes, who is speaking?
It's me, sir. It's still Prosper. Sir, it seems you are too fast, sir. Please, can you slow
Oh,
it
okay.
so we can follow?
So, okay, I'm too fast, right? I should
Yes,
take it slowly. No worry.
yes. Thank
Okay,
you.
you're welcome. All right, then. So let's have one more illustration under convertible securities. Okay. This one is under cost. Okay, let's solve the one that has to do with value, how to determine the value of security. Okay, so let's solve this illustration number 12. What's the requirements? Examiner is asking, should investor convert if the current share price is 4 naira, 5 naira, or 6 naira? So let's go back to the body of the question. Lakaseti PLC has in issue a convertible debenture with a coupon rate of 12%. Each 100 naira unit may be converted to 20 ordinary shares at any time until the expiry date, and any remaining debenture will be redeemed at 100 naira. The debenture has 5 years to run. Investor will normally require a rate of return of 8% per annum on the 5 years debt securities. So, should investor convert if the current share price is 4 naira, 5 naira, or 6 naira? So what the examiner is simply asking you here is that you need to calculate, you need to advise the investor whether they should convert at 4 naira, 5 naira, or 6 naira. For you to be able to answer the question diligently, you need to know, as of today, what is the current market value? What is the market value as of today? Then, what is the conversion value at 4 naira? What's the conversion value at 5 naira? What's the conversion value at 6 naira? Remember what I told you earlier today? Investor will only convert if and only if it is profitable to do so. If the conversion value is higher than the redemption value, therefore, the investor will convert the security. If not, investor will just allow it to lapse at the maturity date and redeem it. Okay, so to solve this question, what we need to do, even though examiner did not tell you to calculate the current market value, but it is implied, you need to know, as of today, if I want to redeem this debenture, at what price? What's the current market price? Then I will now compare with the conversion price. So whichever one that is higher, the price at which the conversion value is higher than the redemption value is the one we are going to select. So let's solve the question quickly within the next few minutes. Let me look for a space. Okay. Okay, let me see if I can manage. Okay, let's see if I can manage this small space here. I don't want to use, I can use Word document, but I don't want to leave this space until maybe when we get a bigger question, then we can be using Word document to solve questions. So, like I mentioned to you in this question of, what's the name of the company again? Let me see. Illustration number 12. Lacazette. Okay, thank you. In this question of Lacazette PLC, now, what you are supposed to do is to first of all calculate the market value, the current market value of the debenture. If the debenture is going to be redeemed now, what is the current market value? So you are going to compare it with the conversion price or the conversion value at 4 naira, at 5 naira, and at 6 naira. Whichever one that is higher is the price at which we should convert. So at this point, I need to first of all calculate the current market value of the debenture. And for me to get the current value of the debenture, I need two things. Remember, the present value of debenture of redeemable debenture is the market value of redeemable debenture is the present value of future cash flows discounted at the yield of the debt. According to this question, the coupon rate is 12%. The coupon rate is the interest rate. I don't need interest rate for now for anything. What I need is the yield. The yield is the rate of return. The yield is the internal rate of return. It could also be called yield to maturity. Therefore, we are now told in this question that the investor will normally require a rate of return of 8%. That rate of return of 8% is called the yield. It's called the yield. Okay, or yield to maturity. All right. So I have the yield of 8%. I will then go to the question, what's my fixed interest? What's my annual fixed interest? According to the question, we are given a coupon rate of 12%. Okay, that 12% will give me, because every year the debenture holder will be receiving the fixed interest at 10% on the nominal value. So that 12% is my interest. So I will then come here 12 naira. Remember what I told you. Debenture is always quoted, debt is always quoted at 100 naira per unit. So you can't come here and be saying, because it is 12%, you now put 0.12. No, because by the time you multiply this 12% on 100 naira, it will still give you the same thing as 12. So that's why we're saying that debt is always quoted at 100 naira per unit. So this percentage, just ignore, forget about the percentage behind the 12, behind the interest rate. Just put convert it to naira like that. Then finally, another variable that I need to determine the market value is the redemption value. How am I going to redeem? If I want to redeem this debenture as of today, if I want to redeem this debenture, at what price am I going to redeem it? The debenture will be redeemed at par, which is 100 naira. Therefore, redemption value equal to 100 naira. Okay, the redemption value is equal to 100 naira. So I've seen the variables I'm looking for. All right, so I can then proceed to calculate my current market value. Okay, so to get the current market value, I will simply go ahead and calculate as if you want to calculate NPV. The name of this company is Lacazette. Lacazette PLC. So I want to calculate the current market value of the debenture. Current market value of debenture. Just as if you want to calculate NPV, but we are not going to put year 0. So I will create a column for year. Description of item. Cash flow. Discount factor at, remember, we said that the market value of debt is the present value of future cash flow discounted at the yield. The yield given to us in this question is 8%. So what we are looking for is the present value. That's what we want to calculate. Therefore, when you want to calculate present value, you don't include year 0. I will repeat. Whenever you want to calculate present value, don't include year 0, because we are saying that The present value, the market value of debt is the present value of future cash flow discounted at the yield or the rate of return of the debt. So you don't include year zero. What we are looking for is just present value. Therefore, and then again, what's the maturity date of this security? For Lacassetti, what's the maturity date of the debenture? We are told that in 5 years, the rate of return per annum on the 5 years debt security. So the debenture has 5 years to run. So in that case, we are going to calculate present value of fixed interest from year 1 to 5. So here will be year 1 to 5. Interest, the fixed interest. How much is the fixed interest? We have determined our interest to be 12 naira, because if in the question you are given tax rates, you need to adjust for tax. But because we don't have tax in the question, that's why we are using the 12 like that. Then at year 5, which is the maturity date, we are going to have redemption value. The redemption value is at par, which is 100 naira. So with this, I can then calculate my present value. Present value. Okay. So if that is the case, I need to calculate annuity factor from year 1 to 5 at 8%. Year 1 to 5 at 8%. I will bring up my calculator to say 1.08 raised to power minus 5 equal minus 1. The answer you have then minus 1 equal. Then divide by 0.08 equal 3.993. Here is 3.993. Okay, so let's determine the discount factor for year 5 at 8%. 1.08 raised to power 5 minus that's 0.681. 0.681. When you multiply 0.681, we are going to have 68. Then 12 multiplied by 12 multiplied by 3.993 equal, that's 47.92. So I have 48, rounding to 48. So 48 plus 68 equal 116. 116. So what that means is that the current market value of this debenture is 116 naira. So like I explained to you earlier on, whenever you are asked to determine the market value of debenture or market value of bond or market value of loan note, is simply the present value of future cash flows discounted at the yield of the debt. The future cash flow is the interest plus the redemption value, which is the principal sum, then discounted at the yield. So in some questions, examiner may not give to you the yield. In this case, we are given the yield of 8%, but in some questions, examiner will not give to you the yield, but there will be information for you to calculate the yield, especially when you get to bond valuation and analysis. We are going to see a similar situation whereby you calculate the yield, then you now proceed to calculate the value. All right. So all of this, when you get to bond valuation, you are going to learn it more. Now, in this question of Lacassetti PSC, we've only solved one bit. The 116 naira is the value as at today. Then we need to determine the you need to determine the conversion value. So examiner has told us that there's price of 4 naira, 5 naira, and 6 naira. At any of which of those prices should the investor convert at? Therefore, I need to calculate the conversion value. I would then say conversion value. I have the share price. Then we have number of shares. Then we have conversion value. Conversion value. Okay. We have share price 4 naira, 5 naira, and then 6 naira. Okay. All right then. So how many number of ordinary shares are we going to convert the debenture to? We are told in the question that 20 shares. 20 shares. Therefore, 4 multiplied by 20 will give me 80 naira. 5 multiplied by 20 will give me 100 naira. Then 6 multiplied by 20 will give me 120 naira. So an examiner is now asking us, should investor convert at 4 naira, 5 naira, or 6 naira? For you to answer the question, you will see that you are going to be comparing the current market value of 116 naira. You compare it with 80 naira. You can see something your worth as of today is 116 naira. Somebody wants to give to you 80 naira. Will you accept? No. That means the investor should not convert at 4 naira. Again, as of today, your worth is 116 naira. Somebody wants to pay you 100 naira. Will you accept? No, because it's lower than your worth. Therefore, investors should not convert at 5 naira. The third one, the share price is 6 naira. Conversion value is 120 naira. As of today, your worth is 116 naira, and somebody wants to pay you higher than your worth. What will you do? You are going to accept. So what that means is that the investor should only convert at 6 naira, because that is the price at which the conversion value is higher than the current market price or current market value. That's it. So it's not just about that. You need to put it in writing. Okay. Because of space, you need to put it in writing. So we'll just come here. Let me use this space. Because these are small questions. So that's why you see all these things, all these working scattered here and there. By the time we begin big questions, so we are going to be using different templates to be doing all our calculations so that everything will be well delineated. So finally, in this question, because examiner is asking you, let's go back to the question. Examiner is asking you in this Lacazette PLC question that should investor convert if the share price is 4 naira, 5 naira, and 6 naira. So because we have calculated our current market price to be 116 naira, we also calculate the conversion value. We got 80 naira, we got 100 naira, we got 120 naira at share price 4 naira, 5 naira, and 6 naira respectively. But because the conversion value of 120 naira is higher than the current market value of 116 naira, therefore, we then say the investor should convert at the share price of 6 naira. Share price of 6 naira. Since this is the price at which the conversion value is higher or greater than the current market value. That's it. That answers the question. However, you must know what you are doing at any question. And that's why I always advise students that whenever you want to solve a question, always start from the requirement, because the requirement will prepare your mind on the expectation of the examiner. You need to, from the requirement, you will know what the examiner wants you to do. All right. So that is the question we just solved. So at this point, we need to move to weighted average cost of capital. Well, before that, I need you to talk to me if you have any question on the or you have any concern on the question we just solved on Lacassetti PLC. Talk to me. Any question so far? So if there are no questions, we move to weighted average cost of capital. Okay. All right. So what is weighted average cost of capital? What's weighted average cost of capital? Like I explained to you earlier today, the weighted average, when you say cost of capital, what that cost of capital is simply saying is your weighted average cost of capital, because your weighted average cost of capital is the overall cost of capital to a company. When a company wants to appraise a project, you will need a cost of capital to discount the future cash flow that the project will generate in order to determine the its present value. Therefore, the cost of capital you are going to use to appraise the project is your weighted average cost of capital. You don't use cost of equity to appraise a project, except if the company is only financed with equity. You don't use cost of preference share alone to appraise a project. You don't use cost of debt to appraise a project. So it is the average of the three sources of financing or three sources of capital that we refer to as the weighted average cost of capital. Therefore, when you want to define weighted average cost of capital, you can say WACC, or the weighted average cost of capital, is the overall rate of return to a firm or to a company, the overall rate of return to a company. It can be determined by finding the proportion of each source of finance to the company's total pool of capital. Say, for example, you have a company, an ideal company, say, is financed with equity. Say equity in this company is 500 million. Preference share, the company is also financed with preference share, say 200 million, then debts of 300. The total pool of capital in this organization is 1 billion naira. It's 1 billion naira. That's the total. Now, each source of finance has its own underlying cost. There is cost of equity attached to the equity financing. There's cost of preference share attached to the preference share capital, and also there's cost of debt attached to the debt capital. Therefore, when you want to determine the weighted average cost of capital, we said that the weighted average cost of capital is the overall rate of return to a firm. Is the overall rate of return to a firm. Therefore, for me to know, I need to determine the proportion of each source of finance to the total pool of capital. What is the weight of equity? To get the weight of equity, I will just simply say 500 million divided by the total capital of 1 billion, which is equal to 50%. What's the weight of preference share? 200 million divided by 1 billion. That will give me 20%. the weight of debt is 300 million divided by the total of 1 billion, which is equal to 30%. So what I mean is that once I've calculated my cost of equity, that cost of equity, I need to find the average. So the average of the cost of the three of them, I need to multiply this weight of equity with the cost of equity I've calculated. I will do the same thing. It's preference share, cost of preference share. I will multiply the weight of the debt with the after-tax cost of debt. So at the end of the day, I will add up the three of them together. That will become my weighted average cost of capital, which is the overall cost of capital to a firm. So this is what we are talking about. So when you talk about weighted average cost of capital, we said that it is calculated as the cost of equity, cost of preference share, cost of debt, then weighted according to the proportion each source of finance is having in the company's total pool of capital. All right. So if that is the case, how do you calculate weighted average cost of capital? There are three ways in which you can calculate weighted average cost of capital. We have traditional WACC, traditional weighted average cost of capital. There's project-specific cost of capital. There's also WACC of the combined activity. The WACC of the combined activity is what I usually call WACUCA. All right. Therefore, all our explanation that we have been doing since, they are under traditional weighted average cost of capital. Okay. All the calculation of cost of equity, cost of debt, cost of preference share, they are under traditional weighted average cost of capital. So when you now want to calculate the traditional weighted average cost of capital, it is simply equity value, your weighted average cost of capital denoted as KW is calculated as equity value divided by equity plus value of equity plus value of preference share plus value of debt. All of this multiplied by cost of equity plus value of preference share divided by total value, that is equity plus preference plus debt value multiplied by cost of preference share plus the value of the debts divided by total value, that is E plus preference plus debts. All of this multiplied by after-tax cost of debt, that is multiplied by KD. There's no space there again, so multiply by KD 1 minus tax. Okay, it's the same thing you have here. That's what I have there is the same thing you have there. So E is the value of equity, P is the value of preference share, then D is the value of debt. All right. So by the time you had all of them together, then of course your answer will be weighted average cost of capital. But you can't use this formula straight. Whenever you are asked to calculate weighted average cost of capital, you can't just go ahead and put down the formula and then you're going to be looking for the variable. What is E in the question? What is P in the question? What is D? It doesn't work like that. You are the one, you must estimate them. Examiner may not give it to you. In most cases, examiner will not give it to you. All the variables you are seeing in this formula, you are the one that will determine it. All right. Therefore, the first working you are going to do is for you to calculate your cost of individual source of finance. What is cost of equity? You need to go and calculate it. That's what I explained to you, how to calculate cost of equity, all those principles I mentioned, where you have a constant dividend, where you have growth dividend, how to convert cum div share price, cum div share price to ex-div share price, and all of that. Just go ahead and calculate your cost of equity. Excuse me. Then again, go ahead and calculate your cost of preference share. Is it redeemable preference share or irredeemable preference share? Once that is done, you keep it on one side. Again, go ahead and calculate your after-tax cost of debt. All right. Okay. Is it redeemable or irredeemable, convertible or whatever it is, whatever the nature of your debt, go and calculate it. Once you have the cost of individual source of finance, then you can You can then come back and put it in this formula to get your WACC. Again, before you can get your WACC, you must estimate what is the value of equity, what is the value of preference share, what is the value of debt. You must go and calculate it. So this will take me to the next item. I want to show you how to calculate market value of equity, market value of preference share, market value of debt, so that at the end of the day, once you understand all those things, then no matter how big is the question, you will not struggle to solve it. You will not struggle to solve it. So let's go ahead. Let me quickly show you how to calculate market value before we proceed. Now, let me use this space. Calculating market value. When you want to calculate market value for equity, market value of equity is calculated as number of shares multiplied by XDIV, share price. That's the formula for calculating market value of equity. But what if in the question you are not given number of shares? How do you then calculate it? If number of shares is not given to you, then you can say equity is equal to share capital divided by nominal price or nominal value. Nominal value per share. Okay, that is your balance sheet price multiplied by XDIV share price. So this is another way of calculating your cost of equity. Examiner, it is also possible that in the question, the share price will not be given to you. How do you then calculate the market value of equity? At your skills level, under financial reporting, you must have done financial statement analysis, all right? Under financial statement analysis, of course, you did ratio analysis. Then your lecturer must have told you how you can calculate your share price. Your teacher or your lecturer must have told you that share price is calculated as the price earning multiplied by earning per share. So this share price is the same thing as your XDIV share price. Therefore, when you now want to calculate the value of equity where you are not given share price, but of course, if you are not given share price, there will be variables for you. The examiner will give you the variables which you are going to use to compute your share price. So, and that's what I've included this formula here. So if you are not given your share price directly from the question, then you can then say value of equity is number of shares multiplied by market price per share or XDIV share price. Your XDIV share price can be calculated as price earning ratio multiplied by earning per share. Okay, so the question will tell you, will show from the question you'll be able to see which of these three formulas you are going to use to calculate your market value of equity. Now, how do you then calculate market value of preference share? The market value of preference share, which is P, is calculated the same way as the market value of equity, in that to get the market value of preference share, you pick the number of shares multiplied by the XDIV share price of the preference share. If number of shares is not given, then you can also say the market value of preference share is calculated as the share capital of the preference share divided by the nominal value of the preference share multiplied by XDIV share price. So that's the formula you are going to use to calculate the present value, to calculate the market value of the preference share. Lastly, how do you calculate the market value of debt? D. How do you calculate the market value of debt? The market value of debt will be calculated as nominal value multiplied by X int price divided by 100 naira. Remember what I told you earlier today? Debt is always quoted at 100 naira per unit. So when you want to calculate the market value of debt, so it could be bond, it could be loan notes, it could be debenture. This is the formula that you are going to use. So I've shown you, because when you get to business valuation, you are likely going to need any of these formulas. So it's important for you to have the understanding now, okay? So that's for that. Now, let's go back to the weighted average cost of capital we are talking about. So how do you then, there are two ways that you can calculate your traditional WACC. There are two ways you can calculate your traditional WACC. You can use book value to calculate your WACC. You can also use market value. So if you want to use book value to calculate your WACC, of course, everything is this, whether you are using book value or market value, is the same formula that you are going to use. However, when you want to use book value to calculate your traditional WACC, then you are going to include your ordinary share capital plus reserve must be added together to get the proportion of equity. Okay, I will repeat. Let me remove this loss of space. Now, I mentioned to you, whenever you want to calculate traditional WACC, it is expected that where examiner is silent, you are supposed to use market value approach to calculate your traditional WACC, because market value is the price determined by the forces of demand and supply, and that is what the investors wants to earn. Investor will want to receive the market the market price, the price determined by the market, not the one you have in your balance sheet in your book. So, however, if an examiner says otherwise, in some questions, examiner may tell you that using book value, examiner can ask you to use book value to compute your traditional WACC. So in that case, when you want to use book value to calculate traditional WACC, in the capital structure of the company, you are going to see how the company finances operation. Now, using book value, you are going to add ordinary share capital plus reserve to form the basis of equity. Let me rewrite this. So using book value, you need to determine the proportion of equity, proportion of preference share, and the proportion of debt. In determining the proportion of equity, using book value, you will need ordinary share capital plus reserve. You are going to add together ordinary share capital plus reserve. Of course, you have your preference share normally as it is. Let me use an example to illustrate that. Say, for example, you have in an ideal capital structure of a company, you have ordinary share capital of 500. You have reserves of, say, for simplicity, 100. You have preference share of 200. Then you have debenture or debts of, again, let me make this one 300. Say this one is 400. Just for simplicity. So when you have the four of them, that's 1,000. Therefore, when I want to use book value, if examiner asks me to use book value to calculate the weighted average cost of capital, I need to determine the proportion of equity, proportion of preference share, and the proportion of the debt. Therefore, for me to get the proportion of equity using book value, you are supposed to add ordinary share capital plus reserve. You add ordinary share capital plus reserve. So I will then go to the balance sheet of the company. What is my ordinary share capital? We are assuming that this is the information given in the question. Therefore, to get the proportion of equity, I will add ordinary share capital of 400 plus reserve of how much? 100 naira, 100 million rather. So this gives 500 million. What's the proportion of preference share? Of course, preference share will be still remain 200, then debt is 300. For me to now get the proportion, I would then say equity equal to 500 divided by 1,000. That will give me 50%. Preference share will be equal to 200 divided by 1,000. That will give me 20%. Then finally, debt will be equal to 300 divided by 1,000. That will give me 30%. So using book value, what this is saying, my simple explanation is that whenever you want to calculate weighted average, you want to calculate traditional WACC using book value, you are supposed to add ordinary share capital plus reserve. Please note that you are going to add ordinary share capital plus reserve. But if you want to use market value to calculate weighted average cost of capital, you don't add ordinary share capital with reserve. What you are going to do is the formula I've given to you earlier on. All these formulas you have here is what you are going to use to calculate your equity. Then you now add the three of them together to get the total. You now say equity divided by the total, okay? Multiplied by cost of equity. Preference share divided by the total value, multiplied by cost of preference share. Debt value divided by the total value multiplied by cost of debt. So that's what you are going to do, okay? So this is how to calculate weighted average cost of capital. Whether it is book value or market value, this is the same formula that you are going to use to calculate your traditional WACC, okay? And yeah, that's it. That's it under WACC. There are assumptions. You can just go through these assumptions and read them through. They are very straightforward. So let me see if we can solve only one illustration before we call it a day, so that in the next class, we are going to solve more illustration under WACC, the likely question you are going to see on the day of your exams. Then once we are done with traditional WACC, move to project specific, then POCA, all right? So let's have illustration. So far, if you have any question, you can unmute yourself and talk to me. Okay? Let me know if you have any question for me. Okay, let's solve this small question illustration number 9. Austral PLC. Illustration number 9, Austral PLC. So, again, like I explained to you, whenever you want to start any question, always start from the requirements, because the requirements will prepare your mind on to understand the expectation of the examiner when you are reading the body of the question. So in this question, we are told that we are asked, what is the weighted average cost of capital using book value, then 2, market value. So what that means is that there are 2 different cost of capital that you are going to calculate, okay? The 2 of them, the 2 different methods cannot give you the same answer, all right? You can't have the same answer. However, so now that you know you want to calculate weighted average cost of capital, you then go to the body of the question. What are the information given? Okay, you are told that The account of Ospra PLC reveals the following capital structure. So this is the way the company finance its operation with debts and equities, So market value of the above shares is as follows. Ordinary share, 3.75 Naira as dividend. Debenture stock, 18 Naira. The cost of equity is estimated to be 20%. The cost of debt is 7.5% after tax. Therefore, what is the weighted average cost of capital? This question is to a large extent very straightforward. The reason being that examiner has already given to us the cost of equity, then the cost of debt. Ordinarily, you are the one that's supposed to estimate the cost of equity and the cost of debt. But in this question, examiner has made life so easy for us. So I don't need to stress myself in this kind of a question. What do I want to do? I want to calculate WACC using book value, using market value. The first thing first I need to do, since examiner has given me cost of equity, I will write out my formula to say, to solve this question, I will say Ospra PLC calculating weighted average cost of capital. 1, using book value. Using book value. Therefore, using book value, I would then say WACC equal to, I will go to the balance sheets of the company. How does the company finance its operation? I can see ordinary share capital. I can also see debt. So 2 major sources of financing. Therefore, I would then say equity value divided by equity plus debt multiplied by cost of equity plus debt value into equity plus debt multiplied by cost of debt. I will go to the question, am I given tax rates? In the question, I don't have anything like tax rate. I'm not given tax rates. That means, and then again, examiner has already, I don't even need the tax rate because examiner has already told me that the cost of debt is 7.5% after tax. So that means the KD has been adjusted for tax. Therefore, I would then say KW equal to, I need to get value of equity. What is the book value of equity? I've told you earlier on, I just explained to you that whenever you want to calculate WACC using book value, you are supposed to add together ordinary share capital plus reserves. So in this question, ordinary share capital is 2 million, reserve is 3 million. Therefore, 5 million divided by 6 million will give us the proportion of equity. So I would then say 5 million, 2 million plus 3 million, that's 5 million, divided by the total value of 6 million. The essence of that is to determine the proportion of equity and the proportion of debt. So multiply by cost of equity, which is KE. Cost of equity, examiner has told us, is 20%. So I will multiply with 20% plus, what's the book value of the debenture? The debenture we are told is 1 million Naira. Therefore, 1 million divided by the total value of 6 million Naira, multiplied by after-tax cost of the debenture. The after-tax cost of the debenture is 7.5%. 7.5%. Therefore, the WACC will be equal to, I'll bring out my calculator to say 5 divided by 6 equal, multiply by 20 equal, that's 16.67. Here is 16.67%. Please forget about the percentage you have behind the 20 or the one you have behind the 7.5. Just move on with your calculator and with your calculation. Ignore the percentage. All right, because whatever the final answer you have, you are still going to multiply with percentage. So just ignore that percentage. Okay, then plus 1 divided by 6 multiplied by 7.5 equal, that's 1.25. 1.25%. Add it up. So 16.67, 16.67 plus 1.25 equal 17.92. Here is 17.92%. Approximately the WACC is approximately 18%. So using book value, the weighted average cost of capital is equal to 18%. Okay, that's that. So let's calculate the WACC using market value. Okay, I need a space. So I using market value is the same formula you are going to use. However, I need to go and calculate what's the market value of equity, what's market value of the debenture. Okay, so my working, I want to calculate market value of equity. I will then go to the question, am I given number of ordinary shares? If I'm given number of ordinary shares, then my the market value of equity will be number of shares multiplied by ex-div share price. In this question, I don't have number of ordinary shares. Therefore, I can say share capital divided by nominal price or nominal value multiplied by ex-div share price. Therefore, 2 million naira is the share capital divided by nominal value per share is 1 naira. The nominal value per share is 1 naira. Okay. Divided by 1 naira. Excuse me. Multiplied by ex-div share price. The ex-div share price given to us is 3 naira 75 kobo. Multiplied by 3.75. What do you get? That will be 2 million. 2 million shares multiplied by 3.75 equal, that's 7.5 million. The market price, the market value of equity is equal to 7.5 million naira. So let's determine the market value of the debenture. The market value of the debenture will be equal to the nominal value multiplied by X int price divided by 100 naira per unit, which is equal to the nominal value of the debenture is equal to 1 million naira. 10% debenture, 1 million naira. That's the nominal value. So I would then say 1 million naira multiplied by, what's the X int price? The X int price is 80 naira. The debenture stock is 80 naira. That's the X int price. So 80 naira divided by 100 naira. 100 naira is constant. Final answer will give us 800,000 naira. So the market value of equity is 7.5. Market value of the debenture is 800,000 naira. Therefore, the total market value will be equal to 7.5 million plus 800,000 naira. That will be 8,300,000. 8,300,000 is the total market value. I can then go back to my formula to say, using the same formula, equity, which is E, is equal to 7.5 million divided by the total value of equity plus debt, which is 8,300,000, multiplied by cost of equity of 20%. I think, let me confirm, cost of equity is 20%. Okay. Plus The value of debt is market value of the debenture is 800,000 divided by the total value of 8,300,000 multiplied by the cost of debts is 7.5 million, sorry, 7.5%. Therefore, I will then bring out my calculator to say 7.5, 7,500 divided by 8,300 equal, then multiply by 20 equal 18.07. Here is 18.07% plus 800,000 divided by 8.3 million equal multiply by 7.5 equal, that's 0.72%. 0.72%. You add the two of them together. Okay. That's 18.07 plus 0.72 equal, that's 18.79. 18.79%. Approximately it is 19%. So the weighted average cost of capital using market value is 19%. The weighted average cost of capital using book value is 18%. So this is what examiner wants you to calculate. So if I don't want to use formula to get my weighted average cost of capital, I can also use tabular method. I can use table to get the same thing. It's the same answer I'm going to get. All right. However, let me see if I can get a small space. Okay, let me demonstrate it for you. If I want to use tabular method to get my weighted average cost of capital, I will do one. Instead of using book value and market value, I will use only either of the two. Let me just use the book value. Let me use book value. If I want to use tabular method to get the cost of, to get weighted average cost of capital under book value, then I will create a column for the type of the security. I will create a column for the value, which is the book value in this case. Then I will create a column for the proportion. The proportion is this cost of capital of individual source of finance. Then I will create a column for the hash total. Hash total. Okay. Then I have equity. I have debenture. Okay. Now, what's the book value of equity? You know, when you are using book value, we said that you should add together ordinary share capital plus reserve. Since ordinary share capital is 2 million naira and the reserve is 3 million naira, that is 5 million naira. So the book value of equity is 5 million. Here I will put 5 million. Let me write that. Here will be 5 million. Then the book value of the debenture is 1 million. Add it up, that's 6 million. So cost of equity as given to us in the question is 20%. I can just say 0.20. The cost of debt as given to us is 0.75. That is 7.5%. Cost of equity is 20%. Cost of debenture as given to us is 7.5%. So for me to get my hash total, I will multiply 500 with 20%. 500,000. Sorry, 5 million multiplied by 0.2 equal, that's 1 million. Here is 1 million. Next one, 1 million multiplied by 0.75. 1 million multiplied by 75 equal 75,000. Add it together. That will give me 1,075,000. $1,075,000. Therefore, my weighted average cost of capital will be equal to the ash total divided by the total market value, total value, multiplied by 100 over 1. Therefore, my WACC will be equal to 1075 divided by 6 million multiplied by 100%. So my KW will be equal to 1075 divided by 6 million equal, then multiply by 100 equal, that's 17.92. Here is 17.92%. Approximately my WACC is equal to 18%. So when you check the one you calculated using formula, you see that it's the same thing. See, 17.92 approximated to 18%. So it's the same thing, 17.92 approximated to 18%. So this is how to calculate traditional WACC. This is a very simple and direct question. In our next class, by the grace of God, we are going to have a bigger likely question, which you are going to see on the day of your exam. The essence of the illustrations we have done so far is just to explain the principle. That is not the kind of question you are going to see on the day of your exam. Okay, so subsequently, we are going to be having a more difficult, complex question. Okay, so please, this is where we are going to call it a day. Let me hear from you, please. Let me hear from you. Any question for me? Let me go back and see. Yeah, Prosper, you are still online.
Yes, sir. So I have a question.
Talk to me.
So during the calculation of the cost of equity, right, using the market value method.
Yep.
Yeah, we got 18.79.
Yes.
So if we approximate 18.79, is it not supposed to be 19% instead of 18%? Yes, sir.
Yes, it's supposed to be 19%. So did I put it? I put 19% now. Look at. Here is it. This is the 19%. 18.7 approximated to 19%.
Okay.
It is my right handwriting. Let me rewrite it. It's 19. Here is 9. Okay. That's it. Yep.
Okay. All right. Thank you, sir.
You're welcome.
But then it now means that we are getting different answers, right?
Of
Because
course,
the
you
first
can.
one gave us 18%, and this is 19. Okay.
Yeah, because different methods are used. Ordinarily, the market value method should give you a higher cost of capital, a higher number. Yep.
Okay. All right, sir. Thank you.
You're welcome. Any other question for me before we call it a day? Some people have have disappeared. No worries. Okay. Debbie, how are you? Hope you are still there. Debbie, Fidelis.
Yeah.
Okay. So, all right, guys, in the absence of no question, this is where we are going to draw the curtain for today. I will see you again by the grace of God next week, Wednesday. However, on Friday, Mr. Shiwaju will be taking you SFM as well. Maybe continue from where he stopped last time. All right. Thank you guys for your time and understanding. I will see you again next weekend. Next week, Wednesday, by the grace of God.
All right.
Thank you, sir.
Thank you, sir.
Good night, everyone.